Hello viewers, during our previous lecture you understood the effect of 4 important adjustments while preparing the final accounts. These adjustments included treatment of outstanding expenses, prepaid expenses, accrued incomes and advance incomes. Today we are going to understand the effect of some more adjustments in preparation of final accounts. Let us start with adjustments regarding provision for interest on capital. Interest on capital is payable by business to businessman. I hope you remember that according to separate entity concept, business firm is different from the businessman and we prepare the books of accounts of business firm and not the businessman. A businessman is internal outsider for the business firm. A businessman contributes to business by bringing in required capital. As a return on this contributed capital, he is entitled to the profits earned by the business. Additionally, he is sometimes also entitled to a fixed rate of interest on the capital contributed by him. Generally, this interest is not paid him during the year. Rather, it is provided for or adjusted at the end of the year. The adjustment related to this can be understood with the help of an example. Let us assume that the balance of capital account as appearing on trial balance is rupees 15 lakhs. Let us further suppose that additional information given outside the trial balance reads like provide for interest on capital at the rate of 8% per annum. This will appear on trial balance like this. As you can see on the trial balance, the particulars column show the name of the account, that is capital account, and the credit amount column shows the amount of capital, that is 15 lakh rupees. Below the trial balance, you can see that there is additional information which reads like provide for interest on capital at the rate of 8% per annum. Now, let us apply the logic to understand the effect of this adjustment while preparing final accounts. If you closely observe this adjustment, you will understand that this adjustment is similar to that of an outstanding expense. As we discussed, as this interest is to be paid by the business firm to businessmen, for the firm it is an expense. As this expense is not yet paid, it is more or less an outstanding expense. If you logically relate this information, you will understand that the interest on capital of rupees 1,20,000, that is 8% of 15 lakh rupees of capital, is yet to be paid by the business firm. So, as you go with this adjustment, the debit effect of this adjustment is that the amount of interest on capital is to be shown as an expense on profit or loss account. As interest on capital is an indirect expense, it will appear on debit side of profit or loss account while preparing final accounts. Now, let us understand the credit effect of this adjustment logically. As the interest on capital of rupees 1,20,000 is yet to be paid by the business firm, it is a liability for the business and shall appear as a liability on liabilities and capital side of the balance sheet. I hope you understand that outstanding expenses are liability for business. As far as this adjustment is concerned, as owner's relationship with business is reflected through capital account in business, so this amount is added in capital in balance sheet rather than showing it as a separate liability. These two effects of this adjustment can be shown as you can see, the debit effect is that the provision of interest on capital is to be shown as an expense in profit and loss account, and the credit effect is that it is to be added in capital in balance sheet. Now, let us also understand the effect of this adjustment technically. For the same, let us first have a look into the journal entry required to give due effect to this adjustment of provision for interest on capital. The entry will be interest on capital account debit to capital account. For our example also the entry will be same, that is interest on capital account debit rupees 1,20,000, the amount of interest shown on the debit column, to capital account the same 1,20,000 rupees shown on the credit amount column of your journal. Once you have passed this entry, now let us relate it with our logical understanding on effect of this adjustment on final accounts. As interest on capital is an indirect expense for business firm and its basic nature is debit, interest on capital account has been debited in journal entry as is governed by the rule debit all expenses and losses and credit all incomes and gains. As a result of this, the amount of interest on capital shall appear as an expense on profit or loss account. We have also understood the same logically. Further, note that capital account has been credited in journal entry. Recall that capital account is representative personal account governed by the rule debit the receiver, credit the giver. Capital account is representative of the owner who has contributed capital in business. As the owner is not yet paid the amount of interest on his capital contribution, he is in the shoes of creditors. Hence, capital account has been credited in journal entry and this amount will be added in capital account in balance sheet. The final accounts will appear like this after giving due effect to this adjustment. As you can see the profit or loss account, on the debit side you can note we have mentioned two interest on capital account in particulars column representing an expense and the amount of 1,20,000 has been shown in the debit amount column. Moving ahead to balance sheet, what you can observe in the balance sheet is the capital account of 15 lakh rupees taken from trial balance is shown in the inner column on liabilities and capital side. Thereafter, interest on capital of 1,20,000 rupees is added to it, making your capital after this adjustment to be 16,20,000 rupees. I hope by now you are clear with the treatment of adjustments regarding provision for interest on capital while preparing final accounts. Now, let us understand our next adjustment relating to interest on drawings. This is a counter adjustment. Interest on drawings is charged by business firm from businessmen. So, it is an income for the business. As a businessman contributes capital in the business, he may also withdraw in cash or kind from business as and when required. As business firms pay interest on capital to owners, it can similarly charge interest on drawings from owners. Generally, like interest on capital, this interest is not collected from him in cash during the year, rather it is charged or adjusted at the end of the year. The adjustment related to this can be understood with the help of an example. We will continue with our previous example relating to interest on capital for proper understanding. Let us assume that along with balance of capital account of 15 lakh, balance of drawings account as appearing on trial balance is 1,10,000 rupees. That implies owner has withdrawn cash or kind worth rupees 1,10,000 throughout the year. Let us further suppose that additional information given outside the trial balance reads like charge interest on drawings at the rate of 6% per annum. We will club the previous adjustment as well and your trial balance will appear like this. As you can see the trial balance, particulars column has mentioned capital account, amount of 15 lakh is shown in the credit amount column and trial balance also mentions drawings account in particulars column where the amount of 1,10,000 has been shown on the debit amount column. After the trial balance, there are two pieces of additional information: provide for interest on capital at the rate of 8% per annum and another is provide for interest on drawings at the rate of 6% per annum. You can see these have been numbered as adjustment 5 and 6, because during the previous lecture we have understood 4 adjustment. 5th was interest on capital and 6th is interest on drawings. Now, let us apply the logic to understand the effect of this adjustment relating to interest on drawings while preparing final accounts. If you closely observe this adjustment, you will understand that this is the adjustment which is similar to that of an accrued income. I hope you understand that as this interest is to be received by the business firm from the businessman, it is an income for the firm. As this income is not yet received, it is more or less an accrued income. If you logically relate this information, you will understand that interest on drawings of rupees 6,600, that is 6% of the drawings of 1,10,000 is yet to be received by the business firm. So, as you go with this adjustment, the credit effect of this adjustment is that the amount of interest on drawings is to be shown as an income in profit or loss account. As interest on drawings is an indirect income, it will appear on credit side of profit or loss account while preparing the final accounts. Now, let us understand the debit effect of this adjustment logically. As the interest on drawings of rupees 6,600 is yet to be received by the business firm, it is an asset for the business and shall appear as an asset on the asset side of the balance sheet. But recall, as owner's relationship with business is reflected through capital account in business, so this amount is also adjusted in capital and is deducted from capital in the balance sheet, rather than showing it as a separate asset on asset side. These two effects of this adjustment can be shown as you can see, the debit effect of this adjustment is the amount of interest on drawings is to be deducted from capital in the balance sheet, and the credit effect of this adjustment is that it is to be shown as an income in profit or loss account. Now, let us also understand the effect of this adjustment technically. For the same, let us first look into the journal entry required to give due effect to this adjustment of provision for interest on drawings. The journal entry for this will be drawings account debit to interest on drawings account. For our example also the entry will be same, the only difference is we are also showing the amount this time. Drawings account debit rupees 6,600 shown on the debit amount column to interest on drawings account 6,600 also reported on credit amount column. Now, let us relate it with our logical understanding on effect of this adjustment on final accounts. As interest on drawings is an indirect income for business firm and its basic nature is credit, interest on drawings account has been credited in journal entry, and this amount of interest on drawings shall appear as an income in profit or loss account. We understood the same logically. Further, note that drawings account has been debited in journal entry. Recall that drawings account is representative personal account governed by the rule debit the receiver, credit the giver. Drawings account is representative of the owner who has withdrawn from business in cash or kind. As the owner has not yet paid the amount of interest on his drawings, he is in the shoes of receiver. Putting it simply, as the owner has not yet paid the amount of interest on drawings, this amount is as good as drawings made by him. Hence, drawings account has been debited in journal entry, and similar to drawings made by the owner, this amount of interest on drawings will also be deducted from capital account in balance sheet. The final accounts will appear like this after giving due effect to this adjustment. As you can see your profit and loss account on the screen. On the credit side of profit and loss account, you have by interest on drawings account rupees 6,600. See the debit side, this is reflecting our previous adjustment. we have also reported interest on capital of 1,20,000 rupees in the light of the previous adjustment. So, I am clubbing the previous and this adjustment. Going ahead to balance sheet, what you can observe in the balance sheet is the capital of rupees 15 lakh is reported on the liabilities and capital side in the inner column under the head capital account, which is adjusted for drawings, interest on drawings, capital and interest on capital. Interest on capital has been added for rupees 1,20,000, which is our previous adjustment. For the current adjustment, we have deducted the drawings of rupees 1,10,000 and interest on drawings of rupees 6,600 as well. After adjusting all these three values, that is adding interest on capital 1,20,000, deducting drawings rupees 1,10,000 and also deducting interest on drawings rupees 6,600, the net amount is shown in the outer column. I hope you are clear with these two adjustments put together, that is interest on capital and interest on drawings. Now, let us take our next adjustment relating to depreciation on fixed assets. Let us first understand what depreciation is. Let us understand the concept of depreciation with the help of an example. Business firms purchased fixed assets needed by it, and these fixed assets are shown as assets in the balance sheet of the firm. I hope you understand the fixed assets. We have been discussing this time and again. Land, building, machine, furniture, all these are your fixed assets. Let us assume that a business firm purchased fixed asset, say plant and machinery. The firm will use this plant and machinery for the business activities. Due to this usage and passage of time and many other factors, the value of plant and machinery will reduce. This reduction in value of plant and machinery due to factors like use, passage of time, etc., is depreciation. With a superficial observation, depreciation appears to be a loss for business firms, but when observed closely, you shall understand that it is an expense, more important, an operating expense for the business firm, as the fixed assets are used for operations of the business. The difference between a routine expense and depreciation is that while routine expenses like salaries, etc., are paid in cash, depreciation is a non-cash expense. Actually, the amount of this expense is paid in lump sum at the time of purchasing the asset and written off in installments during the useful life. Let us suppose if you purchase a machine for rupees 2 lakh with useful life of 5 years, it will imply that on an average the machine will lose value of rupees 40,000, that is rupees 2 lakh divided by 5 years every year. Let us understand this adjustment using an example. Suppose the balance of office building account appearing in trial balance is rupees 5 lakh. The additional information given below the trial balance reads like charge depreciation on office building at the rate of 10% per annum. This will appear like this. As you can see the trial balance, in the particulars column you have office building account, and in the debit amount column you can see the value of this office building, that is rupees 5 lakh. Below that there is additional information reading like charge depreciation on office building at the rate of 10% per annum. Now, let us observe this adjustment and understand its effect logically. If you closely observe, you will find this adjustment also similar to an outstanding expense. You have not provided for this expense during the accounting period, so it is similar to an outstanding expense. Recall that outstanding expenses are shown or added in concerned expense in trading or profit or loss account. So, for this adjustment also, the debit effect will be that the amount of depreciation will be shown as an expense in trading or profit or loss account. If depreciation is direct expense, that means relating to asset directly used in operations like factory machinery, it will appear on debit side of trading account. On the other hand, if depreciation is indirect expense, that is relating to assets not directly used in operations like office building, computers, furniture, etc., it will appear on debit side of profit or loss account. Now, let us understand its credit effect. Recall that depreciation is a non-cash expense that represent decrease in value of an asset for various reasons. So, the credit effect of this adjustment is that the amount of depreciation is deducted from the amount of the opening value of concerned asset in balance sheet, so as to show that asset on the reduced value. These two effects of this adjustment can be shown as: the debit effect of this adjustment is the amount of depreciation is shown as an expense in trading or profit and loss account, and the credit effect of this adjustment is that the amount of depreciation is deducted from the concerned asset in the balance sheet. Now, let us also understand the effect of this adjustment technically. For the same, let us first look into the journal entry required to give due effect to this adjustment of provision for depreciation. The entry will be depreciation account debit to concerned asset account. For our adjustment, the entry will be depreciation account debit rupees 50,000 on the debit amount column to office buildings account rupees 50,000. I hope you understand that this 50,000 is arrived at as a 10% of 5 lakh rupees of the asset value. The asset is rupees 5 lakh, as you can see on the trial balance. Depreciation is 10% of 5 lakh. So, 10% of 5 lakh makes 50,000 rupees. This depreciation is 50,000 rupees. Now, let us relate it with our logical understanding on effect of this adjustment on final accounts. As depreciation is an expense for business firm and its basic nature is debit, depreciation account has been debited in the journal entry, and this amount of interest on depreciation shall appear as an expense in trading or profit or loss account. We have also understood the same logically. What you should note here is that as our example is talking about an asset called office building, so it is not a direct expense for us. The depreciation is indirect expense. Had this been factory machinery, factory building, it would have been direct expense and would have been shown on trading account. This being an indirect expense for business, as it relates to office building, it will appear on the debit side of profit or loss account. Further, note that asset account, that is office building account in the example, has been credited in journal entry. Recall that office building is a property categorized under real accounts and is governed by the rule debit what comes in, credit what goes out. As the office building is losing its value equal to the amount of depreciation, it is as good as equivalent property is going out of business. Hence, the concerned asset account is credited in journal entry regarding depreciation. This amount of depreciation is reduced from the value of asset in the balance sheet. The final accounts will appear like this after giving due effect to this adjustment. As you can see, the profit or loss account in the particulars column we have mentioned to depreciation on office building account, and the amount of 50,000 has been shown in the amount column. As you go ahead with the balance sheet, what you can observe is on the asset side, office building account rupees 5 lakh has been reported in the internal column taken from trial balance. Then amount of depreciation 50,000 rupees has been deducted out of it, and the net amount of 4,50,000 has been shown in the outer amount column. I am sure you are clear with this adjustment on providing depreciation on fixed assets. Let us summarize our understanding on these three adjustments. As you go with provision for interest on capital, the first effect is it is to be shown as an expense in profit or loss account, and the second effect is the amount of interest on capital is to be added in capital in the balance sheet. Going with the second adjustment on charging interest on drawings, the first effect is it is to be shown as an income in profit or loss account, and the second effect is It is to be deducted from the capital in balance sheet. Moving ahead to third adjustment regarding provision of depreciation on fixed assets. The first effect is it is to be shown as an expense in trading or profit or loss account, and the second effect is it is to be deducted from the amount of concerned asset in balance sheet. I hope by now you are clear with the treatment of adjustments regarding interest on capital, interest on drawings and provision for depreciation while preparing final accounts. In our upcoming couple of lectures, we will have an insight into some other important adjustments. Till then, have a great learning. Thank you.